Hey everyone, happy Wednesday. Welcome to the weekly live call or bi-weekly live call so far in 2026. Welcome and welcome back to this call. I'm excited to have you here. My name is Bola Sokunbi. I'm the founder and CEO of Clever Girl Finance. I'd love for you to share where you are joining from. Leave a comment. Tell me where you're joining from. Hello, Agnieszka. Excited to have you here. We have a fun topic. Hello, Barry. Hello, Anita. Excited for you to be here. So today I have a special guest, Mabel Nuñez. I'm going to add her to the stage soon. And we're going to be talking about how to make smart investing decisions. Mabel her platform is called Girls on the Money, and she focuses on empowering people to make smart investing decisions. So it's going to be a really great conversation. We're going to talk about doing that, investing without fear, without overwhelm, and she's going to share key tips and things that have helped her build an awesome investment portfolio. And we'll also be answering questions. And she's also a really good friend of mine. Hi. Hi, Andrea. Hello. Thanks for joining. Hello, Tammy. I'm just trying to figure out how to add Mabel on the screen because she was here before. But I'm just going to share some quick announcements. So if you haven't already joined our course platform, definitely check it out. We have a brand new course platform as of December. We have our over 30 plus free courses on there. We have a bunch of challenges, savings challenges ongoing, including our 26-week savings challenge. And the link is in the bio. You can join the savings challenge at any time. And it's just a really fun community. You get to engage with the other ladies, and you can also schedule a free mentor call when you join the course platform. Also, if you haven't already subscribed to our weekly newsletter, please do. This newsletter goes out once a week, and we share money tips, current topics, our book recommendations, and it's just a great way to keep your mind on top of your finances. So you can scan the QR code or go to clevergirlfinance.com/subscribe. And then if you haven't already pre-ordered my new book, what are you waiting for? This book, it's almost 8 weeks. So I'm counting down, and I'm about to start going into promo mode starting next week. So I'm having a bit of anxiety about it, but I'm also excited about it. You would think that after writing 5 books, this is my 6th book, that my anxiety would be less, but it's not. But you can find these books for pre-order everywhere books are sold. If it's not listed on a certain platform yet, it will be in the next 1 to 2 weeks, but it will be available everywhere books are sold, as an ebook, a physical book, and also an audio book. So I will be recording the audio book in February. And then finally, let's do our binder check-in. So Mabel's going to be joining soon. I have to figure out how to add here, but binder check-in. How are you guys doing your savings challenge? Share in the comments how you are doing. Hello, Tracy Steele Jean. Hello, Heather. Hello, Elizabeth. Hi, Olga. So my binder right now, so far, I have put aside $1,000. I'm so excited. I haven't put any money in it this week, but I'm trying to put $100 slots. So I have $1,000 in here. And again, this is me saving spare change, money I would have spent on random stuff, eating out, spending money on my kids, stuff that we don't need to buy. That's what goes in here. I don't have a fixed amount of what I'm trying to save. I just want to fill up this binder. And so if you want to join this challenge, we've been doing this since last year. Get a binder, open a dedicated bank account, get your cash envelopes. Anita from Clever Girl Finance has an album that she uses that she found from Dollar Tree, and just be intentional about saving something, right? How much can you put aside every week, every 2 weeks, every month when you get paid to put in this binder? It could be for spare change. It could be intentional savings, like to build up an emergency fund. It could be money that you want to put towards a down payment or something. But the goal for this community is to save money. And the only rule is that you build a cadence that works for you, weekly, bi-weekly, monthly, and you have a dedicated place that you're going to put this money, and then you come and you check in. So Andrea, you said that you started 2 weeks ago. Yay! Anita, you said you have $100. I love that. Congratulations. It's growing, right? Those small amounts do add up. So if you have a savings binder update, share it in the comments, whether you're watching this live or as a replay. We are here to cheer you on. And I'm so excited. Agnieszka, you said you owe so much to Bola and Mabel. You graduated from the CGF free courses at Mabel's investment bootcamp. It was life-changing. Listen, I'm going to bring Mabel on so that she can also respond to this. How do I add you, Mabel? I know you're here. How do I add you? Give me a second, everyone. I'm trying to add Mabel to... Mabel, if you can hear me, this is what you should do. Exit and then come back in again because I can't see you now. So I'm just trying to add her in. And I'm looking at the different settings here. Yeah, okay, there you are. Hi,
Mabel. Hey, Bola. So
I figured it out.
I made it, yes. Excited to be here. That was nerve-wracking for a little bit.
I know, I'm like, how do I add her? I have to go read the tutorial later. This platform has changed so much. But anyway, sorry I'm blocking your face, but I just wanted to show you Agnieszka's comment. She was part of your boot camp. And she's really excited. So thank you so much, Agnieszka.
Yes, thank you. Yes, she was part of my boot camp, a great student, also part of my community on Substack. So I love her. So thank you for that beautiful comment. It fills my heart just to hear the feedback. So that's so awesome. Hello, everyone.
So folks who are asking about the binder, Amazon, it's linked below. You can find it in Walmart, different places. Check in the link in the description here below. So Mabel, I'm going to have you introduce yourself. You're a really good friend of mine. I talk to you almost every day on the phone, and I'm excited to have you here as a guest to talk about investing. So tell everyone before we dive in who you are and what you do.
Thank you, Bola. Yeah. So it's first of all, it's nice to have a friend in this, personal finance, self-employment world, because we work from home and stuff like that. So it's always nice to connect and talk about our businesses and life in general. But so I'm the founder of a company called Girls on the Money. So the mission of my company is to teach specifically investing in the stock market. So I do focus on other personal finance things like saving money and high yield savings accounts, credit cards. But my main topic, which I've been doing for about 10 years, is investing because it is my passion. And I always tell people that investing changed my life in so many ways. So I'm incredibly passionate about it because it changed my life. So I want to help other people to understand it and actually take action, because I feel that that's the people can get responsible with their credit cards, they can start saving money, but I think investing is like the intimidating part of the process. They're like, oh my god, like, does it really work? How does it work? Am I going to lose my money? So in my platform, I try to take people away from that fear, teach them how it's done. It's not rocket science, it's very straightforward. And that's what I do within Girls on the Money. And I have books, I have workshops, I have courses, I have my social media platforms, all the things, I guess.
That's awesome. And I just want to clarify, because when people hear investing these days, especially with all of the stuff going on social media, they think, oh, day trading or cryptocurrency. No, we're not about that here. Neither me or Mabel are going to be talking about day trading. We're not fans of that, because most people, 99.9% of people, don't know what they're doing. And the only person who makes money day trading is the person that's selling you that day trading program. Don't do it.
Yes.
We're talking about investing long term.
Yes, being patient with your money, letting it grow and compound over time, like not trying to make $1 million in 20 minutes. That's not how this works. So
yeah, there's no hype on, oh, come on, we're going to teach you how to get rich by tomorrow. We just made $25,000 day trading yesterday. Here's how you can do it. Just buy my course for $7.99.
Yeah.
That's a scam. Don't do
it. Or $8,000, it is ranges, with those.
Yeah, they're $7.99 is too cheap for that course. That course would be like $5,000. Don't do it.
That's wild.
So Mabel, tell us, why the interest in investing? What made you passionate about the stock market and investing, and then teaching other people about how to invest?
So I discovered investing as a senior in college. So I hear all the time how people learn about the stock market in high school or even elementary school. That wasn't my experience. I learned that literally at the last minute, right before my a semester before I graduated college. I took a finance course, and my professor introduced me to the world of investing, and it just blew my mind. I'm like, I think what really impressed me is that he was talking about major corporations like Microsoft and Coca-Cola and Nike, and he was telling us how anybody with any income can own a piece of these businesses. And I was just, to me, that was like, I've never heard that before in my entire life, so I was just blown away by it, and I became so passionate about it. That was like a before and after in my life. So I started reading books about it, listening to, I always say AM radio because it was the early 2000s. So there was no podcast about investing, but there were like some AM shows I would listen to. That's how old school I was. So I just became very, very passionate about it. And then I bought my first investment ever, which we can talk about it later. It was an individual stock. And I bought it a few years after that because I was very scared. Even though I was so interested in it, I was still very hesitant about the markets, which I know a lot of people feel that way. I was still very scared. So it took me about 3 years from the moment I learned about the stock market all the way to buy my first stock to actually take action. And after I saw, how that was performing, I was just like, wow, this is it for me. So I started, allocating more money to it and things like that. But that's pretty much, how I became passionate about it.
That's great. And you also share your story in my book, Grow Your Money, which is really awesome. But I learned about investing literally when I got my first job and the HR person was talking about the 401k. Prior to that, I'd heard about investing, but I was like, this is not my reality. I need to figure out how I'm going to pay for my tuition.
Yes.
Okay. I'm an international student. I have no money. I have to take the semester off. Invest in what? My mom is working like crazy. I'm trying to apply for scholarships. So it was when I got my 401k and I signed up for the 401k and I got curious. I was like, I signed up immediately because they told me about free money, but I got curious to know when I put my money in this 401k, where is it going? And that's how I started learning about investing. I'm like, what does this symbol mean? What does this, like, where is my money going to? So that's how I learned about investing. So we've talked about the topic of this session is smart investing decisions. What would you describe as smart investing in 2026 in today's world, today's economy? What do you consider smart investing?
To me personally, I feel that investing, like high quality proven strategies, don't really change that much over the years. Like, I'm not going to invest differently because there's a new president or because there's this or that going on. That's not my style. Like, I don't change my ways based on what's going on in the world. I feel that there's certain ways to invest that are standard, that are proven, that work in any period of time, because remember, we're investing for the long term over the years. So I feel that in this day and age, I think the most important thing is not first of all, to educate yourself about what good companies are and what good funds are, like index funds, ETFs, what kind of characteristics to look for in those type of investments, and then put your money in those and then just let it be. Like, don't freak out when there's a news about something and the market crashes, and then you're like, oh my God, like, should I change my strategy because the market just crashed? A lot of people think that. They're like, oh, like, last year during the tariff announcements around April, like, there was a huge market crash and people were like, oh my God, like, I need to change my ways because now the world is going to look different. And no, the market crashed for like 5 seconds and then it was back to normal and nothing really changed. So I feel that as long as you have a strategy that works for you, that you feel confident about, that gives you peace of mind, just stick to that and don't let the outside noise affect your strategies. Because I think that's where a lot of people make mistakes, in my opinion. What do you think about that?
Yeah, I agree with you. And I think for me, smart investing in today's world is, like you said, tuning out the noise, but also staying consistent. Because when you look at the history of the stock market, you will see that, in the short term, it ebbs and it flows. There's dips and dips and dips and dips and dips, but if you step back and take a bird's eye view of historically, it's always like this. And that's because population is growing. Demand is increasing because of that population growth, and supply is limited, right? And so as long as humans are still living on this earth, it's there's still going to be demand for solid products, solid services. So that consistency is key, tuning out the noise. And I would say diversification. So I'm not a super risk taker. I'm not part of the investors bro club. I'm not an edgy investor. I'm pretty boring. And so I definitely agree with you. So by the way, if you have questions, definitely ask them. I see one question here. Somebody said, if the market crashes, do we lose money and have to buy again? This is a great question. Maybe I'll let you start with the answer.
So this is such a good question. So when you have an investment account, like let's say with Fidelity or Schwab or Ally, whoever, and you buy an investment, like you have a stock or maybe an index fund. So, you already bought it and you hear like, oh, the market crashed, and then you open your account and you see that you're down like $20. As long as you don't sell it, as long as you don't go into your, settings and click on sell, you haven't lost anything. That's all kind of paper money, I guess you can say it in a way. So if you just let it be, wait things out, 9 times out of 10, if you have a good investment in there, you're going to see it bounce back up, and you're back to making money again, or you're back to profits. So the key thing here to remember is, as long as you don't click on sell or you don't do any actions on your part, no, you haven't lost any money at all. So I don't know if there's a better way to explain it, Bola, but that's
I agree. You haven't lost until you have sold. So when your money is invested, as the investment is going up and down, your money goes up and down with it. But until you have a tangible transaction where you click sell and the transaction is finalized, you haven't lost anything. And the same way, if the investment is high and high and high and high, right, you get your profit when you actually sell, right? It's like me saying, well, this binder is worth $5,000, right? Until I have the $5,000 in cash in my hand.
Exactly.
Right. But the goal is that you want your investments to grow, and over time they do grow with patience and consistency, so that when you do need the money, you can take it out as you need it for those purposes. So yeah, Agnieszka agrees, you don't lose until you sell. So until you sell that asset, it's just something that you own. You own it though, but the value is not materialized. The value of the asset is not materialized until you sell. So ideally, you don't want to sell your assets during a decline. And if you look at the history of the stock market, I was just trying to pull up an image to show you guys. There's a great picture here. I want to try to see if I can show it to you guys. I'll try to show it to you guys. But if you look at the history of the stock market, the market has always recovered. Sometimes it takes a few days, a few months, a few weeks, a few years, but the market always recovers. So I'm going to show you that chart. I don't know if I can, let me see if I can share my screen real quick so that we can talk about this and then move on to the next question. But again, if you have questions, please ask them.
Yeah, such a good question. So the technical terms inside your investment account is unrealized gains or realized gains. So realized comes up when you sell, you click on sell. Unrealized is when you still, you're leaving it alone, you're letting it be, you haven't made any action, action on it.
So this is a chart. I'm going to bring us back on screen later, but this is a chart of the history of the stock market from like 1870 all the way to 2020. And all those red lines, parts of the chart just show different market declines, all tied to economy, wars, natural disasters, human reaction. So you see things like the Great Depression, Black Monday, inflation. Up here somewhere closer to 2020, 2010, you probably see it's not labeled, but the housing bubble, and then 2020 is COVID pandemic. But if you step back and look at that blue line, what do you see over time? Despite the red dips, the market continues to grow because population, demand, limited supply. So with every single one of these declines that has happened, the market has always recovered over time. So can you hear me, Mabel?
Yeah, I can hear you. Yeah.
Okay. So somebody else has a question. You are welcome, Miss PYT, pretty young thing. Tracy Siljean says, when I get an income tax check, I put it in my retirement plan that I'm building myself. Is that wrong? I need you to clarify on this question. What do you mean by an income tax check? And then we'll come back to it. Anita says, could you share your thoughts on apps and services like Robinhood?
So I have nothing against the apps, but in my preference, what I tell like my student clients or anybody that, if you stop me in the street and you tell me, Mabel, what kind of investment account should I open? My first answer would not be Robinhood. I'm a believer in like getting like a full-fledged online brokerage account. And by that, I mean a company like Fidelity, Schwab, Ally, even I would include in there, E-Trade. These are like companies that have been around for many years. And they have a proven track record, and they're not like, and also they don't present investing as if you're playing a game. I think certain apps make investing seem like you're in the casino or something, and I don't really like that. I'm not a fan of that. And also, if you look deeper, you hear about all these crashes that these apps have, like random crashes that you can't even get into your account. Things like that bother me. And also, I think the most important part of it is that with a company like Fidelity or the ones I just mentioned, if something happens and you need to call somebody on the phone, you need to talk to a representative, you can actually call them up. With apps, you have to send an email and wait, I don't know, 24 hours for somebody to get back to you. I'm not really a fan of that. So that's something else to keep in mind when you're selecting your investment accounts.
Yeah, I agree with you. I mean, the apps are great for people who want to learn about investing. A lot of them do like great gamification. So I teach my kids using the Greenlight app, which I'm eventually going to open when they turn 13, open the Fidelity Youth Brokerage account for them. But the apps can be great. My mom even has an Acorns account. But like you, I'd rather have a full-fledged brokerage account. And, I have tried the apps. I do not invest with any apps right now and anymore, because there was a time when I tried a really popular name to be unnamed app. And I put some money in, and it was a great app. But I was like, you know what? Fidelity is much better. I want to move my money. And when I went to move my money, because I did not read the fine print when I opened up the account, there was a 90-day block of me being able to get my money. They took my money in less than 90 seconds.
Yeah, it always.
But for me to get my money out, it was like 90 days. I was like, this is unbelievable. Like 90 days. I've already sold the asset. I could see the cash sitting there in the brokerage account. So I was like, you know what? No, let me just stick with what I know. The big firms have larger asset pools backing them. And because of that, they have bigger customer service options. When you sell Fidelity, you can get withdraw your money the next day. And sometimes when you withdraw money in Fidelity, you can get your money into your account the very same day, depending on how early you do it. So I'd rather go with the bigger brokerage firms. This is purely selfish because I'm not playing games with my money.
Yeah, exactly.
But the apps are great if you're learning about investing. They do a great job. I would say they do a better job than the big brokerage firms at teaching, because a lot of them focus on gamification and breaking down concepts and like simple stuff. Like Greenlight is fantastic. I love it for my kids. And once they get the understanding, then we will move. Let's go back to Tracy Steele Jean's question. Then we'll continue through our list, because we have a lot of stuff to cover, you guys, and then we'll answer questions as we go. So Tracy is talking about her refund tax check. She's putting it in her retirement plan that she's building herself. So I'm assuming a traditional IRA or Roth IRA. Is that wrong? No, that is not wrong. I would say just keep track of your deposits, so that at the end of the year, when you need to file your taxes and showcase how much you've put into your retirement accounts, and to reconcile your statements with your brokerage account, you can give it to your accountant, or you can double check yourself. But you are doing the right thing. What do you think, Mabel?
Yeah, Tracy, I love that. The fact that maybe you don't have access, or anybody here doesn't have access to 401k or 403b at work, and maybe you don't want to waste time with your retirement savings, so you do your own thing. That's amazing, and congratulations if that's the case. If you have access to a retirement account at work, find out if they have a match, and don't just make sure that you're not missing out on free money. Maybe if you have an employer and they are offering that, look into it. Otherwise, you're doing the right thing, and congrats on that.
Yeah, I agree. My camera is here blurred. I don't know what's going on, but we'll keep going. It'll refocus on me again soon. I guess a common question that people ask is, how do I know that I'm ready to start investing?
So how do you know? So I would say, make sure that you have the boring. Oh, there you are, Bola again. Make sure you have the boring stuff covered. For example, make sure that you have gotten rid of most or all of your consumer debt. And by that, I'm talking about credit card debt. Credit card interest rates are ridiculous, and that money adds up like wildfire if you don't take care of that. So I would say that part. Also, building your emergency fund is also very important. And, that's why I call them the boring parts of personal finance, because nobody wants to do that. People just want to jump into, how do I make money? But do you have your foundation organized first? Like, you got to make sure that's taken care of. And then after that, if if you have extra money that you're like, okay, I have my emergency fund, I'm taking care of my credit card debt, I'm not worried about it. Then if you have that extra money, then I would say it's time to start exploring, investing different type of investments like index funds or certain stocks maybe, but start with index funds. But that's after that's taken care of, I would say.
Yeah, I agree. And I think it's important to know your pace. So I always tell people that you should be investing today, no matter where you are with your finances. Even if you have debt, you can invest. However, you need to have a priority. So if you have a credit card that has 25% interest and the stock market on average earns between 8 to 10 or maybe 15% given inflation, you want to prioritize paying down that debt as quickly as possible, but still putting a little bit aside for your future self into your investments. That's my approach. So for example, if you have an employer that offers you a 401k and they offer you free money, definitely contribute enough to get that free money. Some employers will give you 6%, will match 6% of your contribution with free money. Contribute 6% and then focus on paying down that 25% card. Once that card is gone, that very expensive debt, then start putting more into your investments, but still invest something small to take advantage of, the tax benefits. Even if your employer does not offer you something, just you being able to contribute to an employer's plan reduces your taxable income. So there's still a benefit there. But if you have high debt, prioritize it. I think that's the biggest one. And also being able to cover, like you said, your day-to-day expenses, right? Because the last thing you want is for us to go through one of those market declines, like in the screen I shared, and then you need money, but you're having to cash out your investments while the market is down. We don't want to do that.
Yeah.
So there's a question. Hold on. Let's answer Anita's question, then we'll go over more of the content and then come back to, I see another question from 13 Wolfies. So Anita says, is it possible to over invest, for example, putting too high percentage of your income into your 401k?
I don't think so. If you're not, if everything else is taken care of in your life, if you don't have any crazy debt and you have your emergency fund and you have all this extra money, please, by all means. But some people say, like Bola was saying, maybe you want to invest up in your 401k up to the match, and then maybe put any extra money that you have in a Roth IRA or things like that. That could be another option. Like if you want to have maybe different type of investment accounts, you can do that. But if you can afford it and if you everything else is being taken care of, I don't think so.
Yeah, investing is an opportunity to grow your money, right? So the more of it you're able to put away, the more you have to grow. However, for retirement accounts like the 401k, the Roth IRA, the traditional IRA, 403bs, they have a cap, a maximum, right, that you can contribute. So you want to make sure that you don't exceed that maximum, because when you exceed the maximum, I believe there is also a penalty associated or some non-benefits that you won't like. So make sure you don't exceed the annual limit set by the IRS specific to retirement accounts. For your non-retirement accounts, just your brokerage account with your, Fidelity, T. Rowe Price, even your Robinhood, you can invest as much money as you want to. And so there's no such thing as over investing, as long as you're able to cover your day-to-day expenses and you have your emergency fund in place. Let's say you lose your job, you can cover, your expenses for 6 months, for 12 months. You don't have to touch your investment. So the more you can invest, the more your money can grow for you.
Yeah, great point. Great point, Bola, about the limits. Like for 2026, the limit for 401k is 24,500, which for most people, that's a lot of money. So if you can put up to that much, nice. But yeah, don't exceed the limits, because there are fines and things like that.
Yeah. Okay, so Mabel, when it comes to choosing investments, that's a very common question, right? I know you're a fan of individual stocks. I'm a fan of index funds and ETFs, very few individual stocks. But what is in your boot camp? How do you help someone or help your students define their framework for selecting stocks without feeling overwhelmed or overloaded by information? Because when it comes to investing stocks, there's so much noise on social media, so much noise on the news. People think they know this, what's trending, what's hot. A lot of times it's a mistake.
Yes.
So what is a framework you use to select how you invest without overwhelm?
Yeah. So I always say my first love are stocks. My second love are ETFs. I love ETFs, but even though I am a big fan of individual stocks, and I would say 80% of my investment portfolio is individual stocks. I look at it as being conservative in a way, because I only invest in companies that have already proven themselves. You will not see my portfolio any meme stocks, any startups, any IPOs, anything that's like up and coming. Like, when maybe you're reading something online and it says, oh, so and so is going to be the next Amazon. You should invest in this company because in 5 years they're going to transform the world. I don't care about that. I don't put that, I call that junk in my portfolio, because these are companies that haven't proven themselves. They have no track record. All they're going by is hope and dreams. And no, thank you. So my approach with individual stocks is that I only invest in companies that are leaders in their industry. Like, when you're looking at an industry, who's number one, maybe number two. Sometimes there's like two, like for example, Visa, MasterCard are two leaders. Maybe I'll buy both in that scenario. Give me like the best of the best. Also, financials. Do they have money? Do they have a lot of cash? Low debt? Are they making a lot of money? That's another criteria that I look into, and I wanted to write it down so I don't forget. And yeah, just a proven track record, and also companies that have like a cult like following, like they have the biggest market share in their industry. That's what I go for. That's the type of investments that I make. You won't see me getting creative with up and coming anything. So that's how I approach how I add, before I add something to my portfolio. That's how I evaluate it, kind of. That's the gist of it.
Yeah, so you talked about looking at their track record, looking at their financials. Like, that's basically you doing research, right? And Google is your friend, right? I would not necessarily use AI tools for this, only because certain AI tools, I think their data is not up to today for legal reasons and attribution reasons. So ChatGPT is not the best platform to use for your stock research, because its data is not up until January 28th, 2026. It might be like, the last I read, it was 2 years behind. I think that has been updated, but use Google where you can find real-time news. Also, your brokerage company has awesome research tools like Fidelity, Vanguard, T. Rowe Price. That's another reason why I like the biggest brokerage firms, because their research tools are very, very robust. You can see the stock's history, you can read the latest news about it. But even that, I think research takes some time to getting used to. So for me, I'm a fan of index funds and ETF, which is broad diversification. But if I was going to invest in individual stocks, some of which I do have, if you are not an old timer, I'm not buying you. I don't invest in new companies. And if I do not have a personal experience with you, I'm also not buying you. And that's just me, because I need to know what's happening. Like, if I walk into, for example, the Apple store, right? I walk past it all the time when I go to the mall. I walk in it. But if I never see an Apple store, how do I know what's going on with Apple? Not that that's an actual indicator of their performance, but if I don't have a personal experience with you, if I don't see how your update is improving or messing up my phone, Apple's new update is trash, by the way. If I don't see
I haven't updated it. Thanks for letting me know.
Don't do it. My phone is lagging so badly. I'm so annoyed. And then it's getting so hot.
Oh no. Oh my God. Good to know.
And the reason why I'm complaining is because this is like a $2,000 phone. So I have the rights.
Yeah, they love taking our money and then whatever without pay. Yeah, so I agree with Bola. Yeah.
And Niska said Yahoo Finance is good. So again, like Mabel said, it's all about making sure that you understand what you're buying. Do your research. Start learning how investing works. Leverage the research tools on your brokerage firm. You mentioned some red flags, like the meme stocks, whatever.
Meme. I'm like, I call them meme. Yeah, it's meme. Sorry. Spanish is my first language, so some words come out weird.
And then, other things like hype, anything that's trending on social media. Listen, just be a spectator. Don't participate.
Yeah, please.
And also long term. And like when I look at investing topics on social media, it's all over the whole place, right? Things take up so much traction and then people get carried away. Know what your goal is. What is your timeline for investing? What do you want to use this money for? How do you feel comfortable? If you cannot sleep at night, knowing your money is an investment, that is the wrong investment to you, wrong investment for you. So let's take another question from 13 Wolfies. Hi, this is a long-time viewer. They say, when would you personally sell your investments, or at what age? In this case, you already have a fully funded emergency fund, you're not in debt, and you don't have other financial issues.
I guess it depends. Like, this is such an amazing question. So before you started investing, what was your goal for that? Were you investing for retirement? Were you investing to maybe, start a business, maybe leave your job and start a business? Were you investing to, for your education? What was the reason that you were investing in the first place? If you have reached that milestone and you have, you have that investment there, that it was for that reason, then maybe it's time to sell. But if you haven't reached any specific milestone for why you were investing, like for example, for me, when I started investing, I didn't really have, I was 24 years old. I wasn't thinking about retirement. To me, I was going to be 24 for the rest of my life, so I wasn't thinking about that. I was just investing just because. And then eventually I was able to leave my full-time job and start a business because I had that backup. Like I was like, okay, I feel comfortable doing this. So I have reached like a certain milestone. Not that I sold my investments, but at least that gave me peace of mind that I had my investments. So yeah, just think about yourself, your personal situation. Like, why are you building an investment portfolio? And I wouldn't do anything unless you have reached that specific milestone, because it's very tempting to just sell and just let it sit there. And that's not a good strategy. So that's what I would say. Yeah, think about what was your original goal for that investment or account. So
yeah, I agree. It's important to have goals, and also keep in mind that, why would you need to sell all your investments unless you had a specific goal for it, right? So if you're investing for retirement, for example, your goal is retirement, but when you get to retirement age, let's say you retire at the standard American retirement age of 65. At 65, you still wouldn't sell all your investments and cash out because of inflation, right? You still want your money to grow and at least beat inflation. And then you have, hopefully another 20, 25, 30 years of retirement. And that's a huge amount of time for your investment to continue growing. So there is a common investment, strategy of the 4% rule. I don't know if it's still applicable given today's inflation, but basically you pick a percentage that you're going to take out of your account every year, the calculators that you can run. And this is the amount you're going to use for that year. Think about it as paying yourself a salary from your investments. And based on that percentage, you can calculate the money you've designated for retirement for 30 years, 25 years, 50 years, right? Knowing that you're not going to run out of money because you won't exceed this percentage. So the 4% rule was that if you took out no more than 4% of your portfolio, your money would last you 30 years, given, specific numbers and things like that. So think about what do you need the money for, right? If you only need a portion of your investments to, maybe you're trying to move to a different place, you want to start a business 10 years from now, you're investing for a child's college, and you have much more, you only want to think about selling what it is that you need from that investment and just leave the rest to work for you. That's something you can transition on as generational wealth. That's something you can have in place in case you need it for other goals. And it's also having peace of mind in place, knowing that your money is working for you, right? So think about it that way. But again, like Mabel said, be clear on your goals. What are you investing for? When do you need this money? And this will also help inform the type of risks you want to take. So for example, me, I'm investing to transition for retirement and also to transition generational wealth. Those are my two goals. And so I don't have time to play risky games because I need my money to be there when I need it to be there. So that informs my investment decision, allowing me to be conservative / slightly aggressive, but I'm not going all in any hot stock, knowing that I can lose 80% of my investment and never get it back, right? I saw Anita said, I learned the hard way with Dogecoin.
You live and learn.
Fun fact. So I live in Jersey. New Jersey is a data center hub. So lots of data centers are moving here. And what's driving these data centers, the need for data centers, is AI and cryptocurrency. Because people need places to store all of this stuff. I read that somewhere. I thought that was so funny. That's sidebar. You are welcome, 13 Wolfies. Another question from Miss PYT. Maybe I'll let you answer this one.
I don't think the market has anything to do with your credit score. I think the metrics for your credit score are like if you pay your bills on time, like a certain percent, like if you have a certain amount of credit, and then, as long as you don't exceed a certain percentage of, how much credit you have available to you, The factors that have to do with your credit score have nothing to do with investing. So there's two different things.
Another question from Tammy. I was told to invest in companies I buy from. Is this good advice?
Oh, I'm so glad you brought this up because I wanted to bring this up like when we were talking about earlier about stocks. So important. Like the fact that you love a company doesn't mean it's going to make a great investment. So it doesn't go hand in hand. When it does go hand in hand, that's amazing, but it doesn't always go hand in hand. And the example that I always give is that I love Barnes and Nobles. I could live in there. Like whenever I see a Barnes and Noble anywhere in any town, I go in there and I spend hours in there. But I wouldn't buy any stock in Barnes & Noble because the company hasn't been doing well. Amazon is, took over the books market, whatever, different factors. So I wouldn't buy their stock, but I love them as a company. So you got to be very careful with buying stocks based on companies that you love because, they don't always go together. So you always have to do your research no matter what to make sure that, maybe you love them, but they're also going to make you money because that's the whole point of investing.
Yeah, I agree. So when you asked me earlier, I said, if I'm buying individual stocks, I'm investing in companies that have been around for a while, that have a good track record, and that I am familiar with. So being familiar with the company, loving the company is not enough. What is their track record? I mean, I'm sure there's companies that we love that are not performing well right now, but we still love them either because we like their product, but they're just having structural, operational, or marketing issues. Their product might be declining. They may be having cash flow issues. So many factors tie into it. So track record plus you're familiar with it is the combination, not just because you love it. Ms. PYT said you are new to this, and that is why you're here to learn. No shame, no judgment. We all start from somewhere. So you are asking great questions. And Agnista gave a good tip about like the question that 13 Wolfies asked about cashing out your investment. She said, if you have money left over in your kid's college account, like the 529B, you can change the beneficiary and pay for another kid's education. So Agnieszka, one thing to remember is that it's important that you understand your state 529B rules for this point. So for example, I picked New Hampshire 529B at the time when my kids were born, because at that time they did allow you to transition money from one beneficiary to the other. I don't know if this has changed as of current times. I haven't checked, but at the time I remember that not all 529, not all college savings plans, let me correct myself, allowed you to change beneficiary. So make sure that you know what the updated information is now. But this is a very good point. You can most likely transition the money from one child to another if, you have extra money in one child's account, one kid is going to a more expensive school or they're doing a more expensive program, etc. Twyla, you are welcome.
Yay.
Okay, so Mabel, let's talk about index funds versus individual stocks. You lean towards individual stocks, and I'm the opposite. I lean towards index funds. Tell me your reason, and I'll tell you mine.
Well, like I said, I love index funds, ETFs as well. I'm just like more of a fan of stocks, only because stocks are more aggressive in terms of the return on investments that you can get. Like if you compare an average index fund or ETF versus an individual stock, not all of them, certain individual stocks, the return on investment is typically pretty massive when you compare it. And fun fact, which I realized this the other day when I was talking to Bola about this, I've been investing for 17 years and I bought my first ETF index fund only 5 years ago, or it's almost 6 years. It was 2020. So I was shocked at myself, like really, because I had to go back to my accounts and check. I'm like, I waited that long to buy an index fund. And it was because also when I was first introduced to investing, I was introduced to it through individual stocks. And I thought that was fascinating to me. And like I said, I only bought like really good companies. And when I was seeing those returns, I was very excited. So I continued that path. But index funds, ETFs are incredible. Also, the vehicles to invest. They also give you nice profits with more peace of mind. You don't have to like worry about what a company's up to. So if you want to invest, make good amount of money with peace of mind, I think funds are the way to go, in my opinion.
Yeah. And one thing to say about what you said about when you started investing, you lean towards individual stocks. So did I. I mean, 17, 20 years ago, index funds were not as robust as they are now, right? My 401k was entirely in mutual funds. There was no index fund offering at my first and my second job. It was all mutual funds, which are very expensive. They're managed by a fund manager. Index funds are not an option. It was not as robust. So this is like now the investing options in terms of diversification, low cost or no cost, are incredible. Starting out, I did not have that. But I lean towards index funds really because I'm a boring and lazy investor. I also don't watch the news as much anymore. So I used to do a lot of individual stocks. I still have individual stocks, that's just not as many. Like we're just recently talking, me and Mabel talking about investing in Costco, which is a great company. But I lean towards index funds because the index tends to rebalance themselves. Depending on the fund that you are invested in, if you're as a company that's not performing well, it gets pushed out of the index because it's not meeting the benchmark, right? So it's almost like you have a built-in fund manager with your index funds. And I don't watch the news. I recently signed up for I buy my groceries online. I rarely go into the grocery store. Sidebar, there's a lot of commentary on social media now about where you're putting your money. Think really hard and strong about where you're putting your money, right? I do not spend my money at companies I do not agree with at all, point blank, period. But I also will spend my money in a way to support the little person. And I will shop local as much as possible. I will shop independent as much as possible. Amazon, you have to find a balance. This is me. This is Bola sharing her perspective. But that's a sidebar. But anyway, going back to what we were saying, index funds, it's because I am lazy. I don't watch the news. I don't have time to check in, but the individual stocks I do check in on them. So that's why they're both great ways to invest. Irregardless, you have to spend time learning and understanding your investments.
Yeah, stocks are more high maintenance, you can say, and like index funds, ETFs are like, okay, I could just go live my life and chill, like, but stocks are more, you have to be on top of them.
Exactly. So let's talk about investing mistakes. And if you have questions, please ask them in the comments, share them in the comments, share your thoughts and agreements and disagreements in the comments. But maybe what are some common mistakes you find people making when it comes to investing?
So I would say one of the biggest ones we were just talking about that, or you mentioned it not long ago, is buying things based on what you see on social media, based on like maybe you get a random email for somebody you never heard of, but they're telling you to buy this IPO that's coming out next month. Buying things based on how, maybe you go to work and then your coworker is talking your ear off about this company that just came out. Like buying stuff based on what other people tell you to do, or based on hype, or based on excitement, versus buying things based on facts and what you see on paper, you know, you doing your research and due diligence. I think that's a huge mistake that people make, especially nowadays with social media, because there's an abundance of information from random people that you've never heard of in your life, but they're telling you to buy this stock because you're going to make a lot of money, so you're confused. So I will always take it back to doing your due diligence. I think that's one of the biggest mistakes people make. And another maybe not mistake, but a misconception is that you have to have everything perfect in your life to start investing. That's not the case. You're going to waste a lot of time, a lot of years where your money could have been compounding and growing for you if you're just waiting for, like, I want to pay, all my student loans off and be, have a better job and wait to move to another state. Like, please don't wait to everything is perfect, because that's never going to happen. Just like get started, like Bola said earlier, like little by little, build your portfolio, even with $5, whatever it is that you have, because time is a big part of the compounding equation. So if you're wasting decades, it's going to affect you. So, even though it's never too late, like, don't get discouraged, but the sooner you start, regardless of how old you are, it's going to benefit you. So
yeah. And Esther, hi Esther, she asked a question. She said she paused investing to focus on my business and immediate savings goals. Is it too late to get back into the game? And as Mabel said, it's not. And if you had investments that you left alone, that money is still working for you. Life happens, right? Life happens. And sometimes you may have to pause because of job, because of life, because of business, because of whatever it might be. And there might be a window of time where you're not investing. But if you have put something in the market, it's working. Your money is still working for you while you were sleeping. And when you can get back to being consistent, then you do that, right? So I encourage you that whatever season you're in, if you're able to invest now, do it. So that if, for some reason you have to slow down or pause temporarily, no matter what, you still have some money that's working for you for the long term, for the future. It is not too late to invest 40s, 50s, 60s, 70s, 80s. You can transition this money somewhere else. We talked about you not having lost anything until you sell. So this money is going to keep growing for you. I would say for all of your investment accounts, please make sure you have your beneficiaries designated, right? Your beneficiaries can be your kids, your partner, whoever. It can be organizations you want to leave your money to, but do not let that money just sit in the
money,
the vortex.
Yeah, I know exactly.
If something, God forbid, something happens to you. This is the easiest and the simplest foundational part of your estate plan. Designate your beneficiaries on all of your accounts: checking account, investment account, savings account. If you have life insurance, who is a designated beneficiary? Literally, you don't need to talk to anybody to do these changes. Log into your account, and 2 minutes, you've added the information in there. Make sure that you do that. There's another question about Robinhood, Mabel, and I think the reason why people care about Robinhood is because of the situation that they had a few years ago. Do you remember that with GameStop, where
Yes.
they were found to be intentionally blocking transactions because they had like a limit on losses and people trying to cash out their money and paying out the money to their investors. So basically, Robinhood did not allow you to trade or sell so that they wouldn't have to pay out. I think maybe they were short on cash.
Yeah, that was crazy.
That is a company ethics issue. It was. They were penalized. I think their administration changed and yada, yada, yada.
That was.
Listen, trust no one. Even the big firms.
Yeah, they had no shame.
Ear to the ground.
Yes.
And I have worked with Robinhood in the past before. Sorry, my phone is ringing. I'm just trying to make sure that my kids' school. But I worked with Robinhood in the past before this scandal happened. And it was, like, trust. No, listen, do your research. And if something no longer aligns with you, we just talked about where you're spending your money. If something no longer aligns with you, you have the choice to move away, to put your money elsewhere, to close your account. I have done that. So that company that held my money hostage for 90 days, I'm never going to invest with them. I will never partner with them. It doesn't work for me. Because even though it was said in the fine print, the language, I'm not an idiot. Language was languaging, and it did not.
It wasn't clear. I'm sure.
Unsubscribe.
Yeah, they could. If they could get away with it, listen, whatever.
Exactly. Shatina says, I used to work in life insurance as a customer rep, always designate a best beneficiary and keep records. Yes. If you are single, you can put your parents as beneficiaries. You can put an organization you want to give your money to as beneficiaries. Do some research on that. How do you do research on companies? So we just talked about that earlier on in this video. Let me go off tangent again. People often say, oh, this company, that company, this company. I'm like, that's because you heard what they're doing. There's so many companies that we don't hear what they're doing that are 10 times worse than this company that we're hearing what they're doing. You realize that it no longer aligns, make the decision to move, to do things differently. That's what I will say. We love Robinhood here. Listen, I reference, they have a really fantastic website called Sherwood, where they stay on top of financial news. And in some of our newsletters, we actually reference some of their research because it actually is fantastic. Mm-hmm. This is what I wanted to say. We're talking about mistakes, investing mistakes. So I'm going to be very honest. There are people in the personal finance world that will use their influence to convince you to invest. That is a mistake if you go with that investment. So imagine if Bola Sokunbi says, hi, I'm Bola. You've been following me for X years. I'm the founder of Clever Girl Finance. I just bought this blah, blah, blah stock, this crypto stock, this day trading stock, and it netted me this amount of money. Because I've been so successful, I highly encourage you to buy it too. If you ever get a message like that from me, listen, block me.
Yeah, huge red flag, definitely.
Block me. That is a red flag, okay? you invest based on your research. I'm never going to say, oh, go and buy Apple stock because I love it so much. I've made all this money and it's going to be amazing for you. The reason why it's called personal finance is because it is personal. So have you personally done your own research to make sure Apple stock is going to work for you?
Mm-hmm. Yep.
Okay.
Yeah. Same happens with all this crypto stuff. You see celebrities telling you that they bought this coin and that coin, and they're huge celebrities with billions of followers. And then you see all these people running to buy, and next thing you know, that coin crashed, and everybody's up in arms. That happens a lot. So just be careful who you're trusting. To tell you to buy this or that.
Yeah, and I've been seeing a lot of celebrity endorsements for gambling apps marketed as investments. Very dangerous. So this is all about discernment and wisdom, right? And what we do at Clever Girl Finance, what Mabel does at Girls on the Money, is we empower you with knowledge to make your own decision for your unique situation. Okay, that's what's important. Be able to discern. You and also oftentimes when something is too good, like you in deep down in your insides, at the pit of your belly, you're like, girl, this is not
this sounds weird. Yeah,
this is a bad idea. You know it, right? So Ms. Shatina said that's part of the get rich quick scheme. People don't do their research and some are easily impressionable. Agnieszka said one of her errors was buying too many stocks from recommendations. Aaron Moore said, oop.
It's all good. You're learning. That's how we get higher in life. So
they said they invested in Robinhood yesterday. So listen, nothing wrong with Robinhood. Like I said, do your jokes aside, because like we're laughing and being funny. Do your research. Be comfortable. Look up the history of this company, where they currently stand. I believe in grace and forgiveness. We have all made mistakes. If we do not give ourselves grace, we don't give others grace, there's no growth, right? So Robinhood made a mistake at that time. And now they have, I believe, recovered. I don't follow them. So do your research. So important. 13 Wolfies, Miss Shatina has some tips for you. She says she used to work in insurance. If you're single with a life insurance policy, you can designate a family member or even pre-plan your funeral services and designate the funeral home. So good information, hard to digest, but it's important for us to know. Thank you. Thank you, Miss Shatina. Okay, so any more questions?
These are such great questions. I could stay here for 5 hours.
I know, it's been such a fun time. I'm just looking on my notes here. So Mabel, what would be your final peace of mind for someone who is trying to get serious about investing? And then also, please tell everybody what you offer about your boot camp, the names of your books, where to find them, your investing course, etc.
Yeah. So first of all, if you're just sitting here wondering, should I get started? Is it too late? Is it too early? No, please just get started. Open an account with my favorite account. And this is not sponsored. I wish it was. It's Fidelity. Like if you were to ask me for a list of
that's mine too.
Yeah, they're like great in terms of like the features that they offer and the perks that they have for their users. So if you are confused, like which one should I open? I would say that one, but there's plenty more, like we mentioned before, Schwab, Ally, there's others in the market. Open the account, fund it. We're living a day and age where you don't need a certain amount of money to get started. If you only have $20 to open the account with, that's all you need. Like just let time be on your side, because the sooner you begin, the better. So just get started. Don't think it's too late. Don't think you have to be perfect. Don't think that everything has to be ideal. Just get that ball rolling. And if you have any questions, you have Bola as a great resource. You can reach out to me or whoever you can trust. Like there's a lot of personal finance people on social media. Just find somebody that you can trust, that doesn't look sketchy, that you don't see them promoting random things every 5 minutes. Like just be cautious with that. You can find me growsonthemoney.com is my website, or I have a Substack as well. I think Bola put the link in the show notes, growsonthemoney.substack.com. Instagram, Girls on the Money, everywhere where it's Girls on the Money. I've had this platform for over 10 years. So if you see Girls on the Money, it's probably me. As long as I don't have any extra things, those scammers on Instagram from, they try to like scam people with extra letters on the name. But so yeah, I teach a boot camp 4 times a year. It's a investing boot camp where I go from the very beginning, how to open an account, all the way to how to do research of individual stocks and ETFs and index funds. It's about 7 weeks, sometimes it's 8 weeks, it depends. But it has a lot of content in there, a lot of information. There's coaching involved. I also have like mini workshops that I teach, every couple of months on, different investing strategies. And my Substack as well is a great resource. But yeah, just, find me on anywhere on social media, Facebook or Instagram, and, DM me or send me a question, anything, and then we'll connect from there. But yeah, and thank you for being here. This was amazing. And thank you to Bola for offering this space.
You're welcome, Mabel. There are a few more comments. I'm going to share one question before I let you go. Since I have you here, this is a rarity. So Tyler said she uses a public investment app because Fidelity and Vanguard sounded overwhelming. And honestly, it still does. What are your thoughts?
So something that I forgot to, Agnes, I think, put a note. One of the comments was that Fidelity has an app as well. So every single one of these big intimidating brokerages, which I completely understand, they also have apps, which you might, you can, maybe it will be less intimidating for you to actually use the app instead of logging into the account through a laptop or computer. So try that. I'm not sure what you mean by public investment app.
I think it's like maybe just like one of these, like a Robinhood or Acorns.
So that's fine if that's what got you started with investing in the first place. If that was enough to motivate you, then that's fine. They're not going to steal your money like this. Obviously, yeah. Even though these platforms that some are better than others, they're all under certain regulations, like federal rules. So they're not going to run away with their money. So don't worry about that. So if maybe if a Robinhood is less intimidating, or an Acorn or whatever, hey,
or Greenlight, do what allows you to understand, learn, convenience, and then over time, you may feel like, what the services. What you will find is that as your investment grows, you may realize, okay, I need more of a human touch, which this app doesn't offer. I need to be able to walk into a branch, which the app doesn't offer, and then you kind of know when you're outgrowing the app. But again, many of them have great educational resources, gamification resources that they do much better than the big brokerage firms, because their goal is to attract new investors. So whatever works for you is great. Tammy, you met an enemy of progress. Okay, this person who said investing $3,000 is a waste of time is an enemy of progress. Move on.
Oh, horrible. So that's $3,000 is a lot of money to start your investing journey. So I'm just mad they said that to you.
A good bank and a good banker is someone who you come in there even with $1 and they want to establish a banking relationship with you and they want to help you grow. Many banks are affiliated to big brokerages, right? There are banks, if you think about there are brokerages that have a banking arm and a brokerage arm. And some of the brokerages are fantastic. But again, a good bank and a good banker, no matter how much you have, even if you're coming there with zero, they want to nurture a relationship with you to help you build wealth, because when you make money, they also make money. So, reassess the whole entire banker situation.
That's horrible. That person's fired. I'm sorry.
Aaron Moore said, can we switch from one platform to the other?
You can,
but yeah, go ahead, Mabel.
For some of them, like for example, if you try to move your like for example, if you have stocks in Robinhood that you really like, that you don't want to sell them, you can do something that's called in-kind transfer, where you can move them into maybe Fidelity or whoever else, but there might be a fee involved. So it depends. It could be $50, it could be $90. I'm not sure, but you have just look into what the fee would be. So.
Yes, and then the other issue with the smaller brokerages. Sorry, Tammy said she left that bank. Good for you, girl. 13 Movie says rejection is God's promise. The other thing with the smaller brokerages or apps is that sometimes you have to initiate a taxable event in order to move your money, which means you have to sell your stocks and then go and rebuy them. That is not always ideal, depending on what the market is doing. When you sell your stocks, again, you create a taxable event, which is capital gains tax. You have to pay at the end of the year whenever you file your taxes, etc. So ideally, you want to be able to switch the investment without cashing it out. Kind of like when you think about doing a rollover IRA, you're not cashing out your investment, you're just rolling from one place to another. Kind of like that, without creating this taxable event. So it's worth asking, like, what happens if I want to move my investment to another brokerage? So for example, I used to invest with my kids at Stockpile. I don't know if they still exist. And that was great at that small age because it had the pictures of the Nike and all. It was cute. And then my kids outgrew it. We talked about that. And I wanted to move them over to like Greenlight. And I had to sell the investments in order to, I couldn't do a transfer of assets. I don't know what the term is. There's a term for it. So keep that in mind. I see one more question. I hope that's helpful. So definitely ask your brokerage that you're using. One more question. I'm going to let you go, Mabel. Blue Butterfly says, can we talk about financial advisors? I would like to fire mine and start to control by self-directing my investments. What are your thoughts?
Listen, if you ask me, I'm the biased person to ask about financial advisors because I would tell you fire them yesterday. I feel that most people, 99% of people, or maybe 90%, they don't need it. Like if you are somebody that has a lot of assets, that you have homes and you have all these, money, all these assets that maybe feel a little bit out of control for you, that you need somebody there to manage it for you, maybe that's where it's worth it. But if you're just building an investment portfolio, and you're educating yourself about index funds and ETFs and some stocks, this is something that you 100% can do on your own. You will be saving all those fees that they will charging you, and look at what are they doing? Like, what are they buying? If they're buying the S&P 500, things that you can do yourself, like what are you paying them for? Like, or maybe they're putting your money in risky things, which will be not good. So at least when you're managing your own investments, you know what you're doing. As long as you educate yourself first on what you want to put your money in. But yeah, I'm not a fan of most financial advisors, and I think they have a place. Yes, they do. They have a place in your life depending on your situation, in my opinion.
Yeah. I think financial advisors can be good. It just depends on what their purpose is. So I reference a financial advisor primarily for estate planning reasons. Yes. As I start to set up and build out my estate plan, my estate plan is not, I have this estate plan. It's like a step-by-step work in progress that me and my husband are navigating with the guidance of a financial planner. Definitely take advantage of the not for fee or not for commission financial advisors at the big brokerage firms. A lot of times they can assess your portfolio really quickly and say, you know what, there's opportunity for you to improve your tax loss harvesting, opportunity for you to rebalance your investments this way. They're not telling you what you must do, just telling you from their experience. And because there's no fee associated to it, because you already have an account with this brokerage, they're just giving you general advice. And a lot of times Fidelity, I remember when I was starting my estate planning journey, I reached out to Fidelity and they connected me with a department in Fidelity that specifically, they don't do estate planning for you, but they had the insight as to what I would need to do. All these, when it comes to like setting up an estate plan, it can be as simple, as complex as you want it. And they were able to guide me with resources. Estate planning is not my expertise, right? So it can be beneficial. When you're going to talk to a financial advisor, think about it as a date. Your boyfriend, your girlfriend, whoever the person might be, you got to get to know this person. You're going to, you're not just going to move in with somebody that you just met on the first date, right? It's the same way. It's a relationship. Can I trust you with my life savings? Mm-hmm. Like, do I like your philosophy? What do you know about money? You're getting to know them. A lot of people put too much trust in a financial advisor because they're a financial advisor. They expect perfection, but they might be a fantastic advisor, but you don't like their personality. You don't like their philosophy. You don't like their communication methods. You got to get to know them. And you also have to be clear on your goals and your intentions for your money, because you are the one who worked for them. You're the one who worked for the money. The advisor is just an advisor.
For you. Yeah, they're working for you.
Mm-hmm. Right? So keep that in mind. So if you need to fire your advisor because you don't like them, that's fine.
That's enough.
If you're going to start investing on your own, start learning. Empower yourself with education. That is so important. And inspiration by JSO Anya said, educating yourself is financial freedom. So This is what we wanted to cover today.
Yes, I think Bola's new book, I think it touches up on these topics. So please.
Chapter 4, I talk about investing.
Yes. If you want to start somewhere.
How am I investing? Me. This is about me, yes.
Yes, great start.
But your homework for today is, number 1, follow Mabel on Instagram at Girls on the Money. Join her Substack. Let me put them back on the screen. Follow her at Girls on the Money. Join her Substack. And then choose a company that you're curious about, an investment you're curious about, and just spend some time on Google, Yahoo Finance, Google Finance, your brokerage firm. Spend some time just researching this investment. You don't have to buy anything. You don't have to open any account, but just spend some time researching this index fund or this ETF. Clever Girl Finance, Mabel's platform, Girls on the Money. We have tons of investing resources. Mabel has a boot camp. Clever Girl Finance has the free investing foundational courses. There's so much information for yourself to empower yourself with knowledge to make the decisions, right? So I want you to spend some time doing your research and understanding how investing works. Subscribe to our platforms. Follow us on social media, and then if you guys have enjoyed having a guest or enjoyed having Mabel here, let me know that you want me to bring her back.
Yes, I would love to. This was so much fun. And these questions are amazing. The audience is great. Like, your questions are perfect. So
yeah, these ladies and gents who join the live are so fantastic. I appreciate your time. We're so grateful that you made time to be here, and we will talk to you next time. Mahalo, more. Yes, we'll be back with more. Than bring her back. Yes, come back. Thank you so much, guys. Thank you. Talk to you next time. Bye.